Today we're starting topic 10, the first 9 topics in accounting, going all the way back to the beginning of the first semester in this 2-semester course, deals with the accounting cycle. You see the 5 steps of a typical accounting cycle on the screen, and we spent quite a bit of time with all of these steps. Let's go through quickly the 5 listed here. We begin with any kind of a business transaction. Businesses sell things, they buy things, something happens particularly that impacts the money of the business, and this is where the accounting staff comes in. So when a business transaction takes place, that's step 1. The second step is now to take that information, that transaction, and to enter it into the first book of the business called a general journal. That process is called journalizing. The third step is to take that information from the journal and put it into the second book of the business called a general ledger. That process is called posting. You've done an awful lot of that, not only in the first semester, but also now in the second semester. Step number 4 in the accounting cycle is to construct financial statements, and we dealt with 2 of them, balance sheet and the income statement. And then finally, step number 5 was what we talked about in topic number 9. Closing entries are journalized and posted, and this finishes our accounting cycle. Now we're going to take a look at elements of the same accounting cycle, but in more detail, and particularly in more detail with larger companies. And we'll show why in just a few moments. But we're going to begin in topic 10 with something called multi-column journals. And these are of several kinds, as you see listed here, and they're called multi-column for the obvious reason. Instead of having just a debit column and a credit column, these journals have more than that. So it sounds more complicated, but it really is a function of being more efficient. And not only being more efficient in the process of journalizing, but also enables companies to divide the work, as we'll see in just a moment. So let's take a look at the kinds of journals. There's something called a multi-column general journal, similar to what you've had in the past, but with more than just 2 columns. There's something called a sales journal, something called a purchases journal, a cash receipts journal, and a cash payments journal. As I said, this allows companies to be more efficient, but also to divide the work. So some people may deal with only sales in our accounting department. Some may deal with only purchases as part of the accounting staff. So it enables more than one person to be involved and become more efficient for larger companies. So we'll take a look at those multi-column journals beginning in topic 10. We also will talk about more ledgers. We still have the general ledger as we have had in the past. No changes with that one. But we now have something called subsidiary ledgers as well. And there are 2 kinds, accounts receivable and accounts payable ledgers, as we'll see in the near future. So I want to take a look at another tab at the bottom here. You see on this page of the spreadsheet a chart of accounts for the Advanced Technologies Corporation. This is the name of the company, and the chart of accounts is pretty much what it sounds like it might be, simply listing all the accounts and the account number for reference by anyone on the accounting staff. But I want to take a look at the kinds of accounts. Some of them are new that we will be dealing with in the near future. And you will see on the left side what we call balance sheet accounts, and that's just what that means. These are the accounts that you would find on a balance sheet. On the right are the accounts that would be found on the income statement. So under the assets on the left side for the balance sheet accounts, we now have something called current assets, not just simply the word asset, but current assets, including cash. We've had that very often, but something called petty cash that we'll be dealing with. Accounts receivable you've had very often in the past, but now we have something called allowance for uncollectible accounts. unfortunately, sometimes customers don't pay us what they owe us. So this account we will deal with. Inventory is going to be handled a bit differently in the larger company, as we'll see. So we have this account called merchandise inventory, and then some other typical supply accounts, office supplies, store supplies, and then something called prepaid insurance, something that again is listed as a current asset, as we will see. Then we have in this company a listing of plant assets, office equipment, depreciation. We've had that just recently. Depreciation for the equipment, the office equipment, and then store equipment and its accumulated depreciation account. Liabilities, we've got some that we've had before. Accounts payable, the payroll tax liabilities that we've had before. Now something new that we will deal with in topic 10 called sales tax payable that we will spend quite a bit of time with. Unemployment tax that we have to deal with. A couple things that might be benefits for employees. U.S. savings bonds payable. What this indicates to us is that we are withholding money for the employees and buying U.S. savings bonds on their behalf. Same way here. The employees want to donate to United Way. This is an optional thing for the employees. So we have an account called United Way Donations Payable. So we deduct money from their paychecks and then contribute to United Way on their behalf. Dividends payable, this is a corporation, so we have to deal with something called dividends payable, and we'll take a look at that in the near future. Stockholders' equity now, instead of one account, has several. Something in this case is a corporation, so we have something called capital stock, retained earnings, dividends, and then the income summary account that we learned about in topic 9. We still have that. Let's take a look at income statement accounts. Now not only do we have a revenue account called sales, we have something called sales discounts. And we'll talk about how that is handled if we are giving a customer a discount for some reason. Sales returns and allowances, an account that deals with money that is returned or allowances that we have. So sometimes customers return things to us. So we have to allow for that in some way. This is a new account that enables us to do that. Now we have a whole category, new category called cost of merchandise. And we have something called purchases discounts. Sometimes we get a discount when we buy things, and sometimes we return things as well. A number of operating expenses. A lot of these we've had before, advertising expense. Credit card fee expense is a new one that we'll take a look at because a lot of transactions now are done with credit cards. Depreciation you've had before. Some of these should look familiar to you. Again, something new down here called uncollectible accounts expense that we will learn in a week or so. And then something called income tax expenses separated out. The federal income tax expense and the state income tax expense. So the chart of account has some new accounts that we will deal with in the course of looking at the accounting cycle for a larger business. And then these are the subsidiary ledgers. These are the new ones that we have in addition to the general ledger. The accounts receivable ledger has an account for every one of our customers. These are customers of our business. They owe us money, so we have to keep track of what they owe to us. And each one has what's called a subsidiary ledger. On this side, accounts payable ledger. These are creditors. These are companies to whom we owe money. So we have to find out how those accounts are handled as well. So that gives you kind of an idea of where we're going in the last couple months of the course. And as we said before, topic 10 will deal specifically with multi-column journals. So I'll ask you to go at this point back to your course page.